The Intelligent Investor, a book written by the great investor, Benjamin Graham. Benjamin Graham was a renowned American investor, economist, and professor. He's considered the father of value investing. Graham's investment philosophy emphasizes fundamental analysis, margin of safety, and long-term investing. His ideas have influenced many successful investors, including Warren Buffett. Some call it the Bible of investing. Warren Buffett calls it the best book on investing ever written. Such comments should give you a conviction that this is a summary you need to listen to, and better still, a book you need to read the details. But here's the thing. The Intelligent Investor by Benjamin Graham is not about getting rich overnight. It's about building wealth that lasts for a lifetime. Today, we'll unpack the timeless principles in this masterpiece so you can become a smarter, calmer, and more successful investor, even if you're starting from zero. Let's get into it. 1. The difference between an investor and a speculator. Graham starts by drawing a sharp line between investing and speculating. Investors buy assets that produce income over time. They look for value, stability, and long-term growth. Speculators, on the other hand, chase quick profits, betting on short-term price movements. He says, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else? That's speculation. To put this in better context, principal, as stated, is your invested capital. Key takeaway: if you're buying stocks without analyzing the business, you're not investing, you're gambling. And over time, gamblers lose. So do your analysis right, and if you're not good at that, seek the services of those who can. 2. Mr. Market, your emotional business partner. Graham uses a brilliant analogy. Imagine you own a small business, and every day your partner, Mr. Market, comes to you offering to buy your share or sell you his. Some days, Mr. Market is wildly optimistic and offers crazy high prices. Other days, he's depressed and offers bargain deals. The intelligent investor doesn't dance to Mr. Market's mood swings. Instead, they buy when prices are below intrinsic value, sell when prices are above intrinsic value. Ignore daily market noise in between. Lesson: the stock market is a voting machine in the short term, but a weighing machine in the long term. 3. The concept of margin of safety. Graham's golden rule: always invest with a margin of safety. This means buying investments for less than they're truly worth. Why? Because the future is uncertain and mistakes happen. A margin of safety acts like a cushion, protecting you from bad luck or misjudgment. Example: if you think a company is worth $100 a share, you might only buy if it's $70 or less. That way, even if your calculations are off, you're still likely to do well. 4. Defensive versus enterprising investors. Graham divides investors into two camps. Camp number 1, defensive investor. This camp focuses on safety, minimal effort, and long-term returns. They have diversified portfolio of quality stocks and bonds. They also avoid market timing and risky ventures. Camp number 2, enterprising investor. They are willing to put in time and research for potentially higher returns. And they hunt for undervalued stocks, special situations, and market inefficiencies. You need to choose your category based on your time, effort, and emotional tolerance, not based on greed. 5. The importance of discipline and patience. The intelligent investor doesn't chase hype, panic in downturns, or dump investments based on short-term noise. Instead, they stick to their strategy, rebalance periodically, accept that downturns are normal and temporary. Mindset shift: bear markets aren't a reason to sell, they're a reason to buy at a discount. For context, for those who are new to investing, stock market or forex trading in general, bear market is when price is in a downtrend, and the opposite is bull market, when price is going up. 6. Bonds, stocks, and asset allocation. Graham recommends a balanced portfolio. 50% stocks, 50% bonds as a baseline. Adjust based on conditions, but never less than 25% in either. Why? Bonds provide stability during market crashes, while stocks fuel growth over time. 7. The timelessness of Graham's wisdom. What's amazing is this book was first published in 1949, yet every principle still works today. The reason? Graham's advice is based on human nature, and human nature hasn't changed. Markets will always swing between greed and fear. Intelligent investors use that to their advantage. Benjamin Graham taught us that investing is not about predicting the future. It's about preparing for it. By focusing on value, discipline, and a margin of safety, you protect yourself from the chaos of the markets and give yourself the best shot at financial freedom. Graham's teachings continue to shape investment strategies and philosophies, emphasizing disciplined and informed decision-making. Benjamin Graham's concept of investing is more of liquid investment, which are in stocks, bonds. Remember, there are other forms of solid investments, such as real estate. But if you want to be really financially independent, investment in liquid assets is very key. This ageless book will get you started solidly on this path. If you found this summary valuable, check out our playlist for more book breakdowns on wealth, business, and personal growth. And remember, wealth isn't built in a day, but it is built daily. Do well to like, subscribe, ring the bell, and share to someone who needs this knowledge. I wish you the very best of luck.